Every single month, millions of ordinary people hand banks free money, not because they're forced to, not because the law requires it, but because nobody ever sat them down and explained what is actually happening to their hard-earned cash. I was one of those people. For years, I thought I was doing everything right. I had a savings account, I paid my bills on time, I never missed a credit card payment, I thought I was being responsible. But what I didn't realize was that every single habit I had built around money was quietly making the bank richer and keeping me exactly where I was. Today, I'm going to show you the habits banks are silently counting on you to keep forever. And more importantly, what to do instead. Because once you see this, you can never unsee it. And the moment you change these habits is the moment you stop working for the bank and start working for yourself. Now, before we dive in, I want to be clear about something. Banks are not evil. They are businesses. And like any business, they have one goal: to make as much money as possible. The problem is, the way they make money is almost entirely built on what you don't know. Every product they offer, every service they push, every fee they charge is designed around one thing: your financial ignorance. And the habits we're about to talk about are the ones banks spend billions of dollars every year hoping you never question. So, let's get into it. Let's start with the one that affects almost everyone watching this: your savings account. Now, you were told your whole life that saving money is smart, and it absolutely is. But where you save it changes everything. The average regular savings account at a major bank pays somewhere around 0.01% interest per year. Let that sink in for a second. If you have $10,000 sitting in a regular savings account, the bank pays you exactly $1 a year in interest. $1. Meanwhile, inflation is running at around 3% per year. That means every single year your money sits in that account, it is actually losing purchasing power. You are getting poorer while feeling like you're being responsible. Now, here's what the bank doesn't tell you. They take your deposit and lend it out to other people at 7, 8, 9% interest, sometimes higher. So they are making hundreds or even thousands of dollars a year using your money and handing you back $1. That is the deal you agreed to when you opened that account. The fix is not complicated. High-yield savings accounts exist at online banks right now, paying 4 to 5% interest. Same government insurance protection, same accessibility, completely different result. If you have $10,000, the difference between 0.01% and 4.5% is $449 a year, every year, just sitting there, no extra work, no risk. The bank never tells you this account exists because your ignorance is their profit margin. That is habit one, and it costs the average family thousands of dollars over a lifetime without them ever realizing it. This one is not an accident. The minimum payment was designed by very smart people specifically to keep you paying forever. And it works. When you carry a balance on a credit card, the bank charges you interest every single month. The minimum payment is calculated to be just large enough that you feel like you're making progress, but just small enough that the interest keeps accumulating faster than you can pay it down. Let me give you a real example because the numbers will change how you think about this forever. Say you have $5,000 on a credit card at 22% interest. The minimum payment might be around $100 a month. If you only pay that minimum every single month, it will take you over 15 years to pay off that $5,000. And by the time you're done, you will have paid almost $8,000 in interest on top of the original $5,000. You borrowed $5,000 and paid back $13,000. That is not a credit card. That is a trap with a piece of plastic attached to it. The bank didn't offer you that card because they believe in you. They offered it because they ran the numbers and they knew most people would carry a balance. You are the product. Even just doubling your minimum payment every single month cuts that 15-year timeline down to under 3 years and saves you thousands in interest. The math is brutal, but the solution once you see it is simple. Banks and subscription companies figured out something very important about human psychology. Small amounts feel invisible. Nobody panics about $9.99 a month. Nobody calls to cancel a $14 charge. Nobody questions the $7 app they downloaded 2 years ago and never opened again. But add those invisible amounts up across a year, and the picture changes completely. The average household is paying for somewhere between 2 and 3 subscriptions they either forgot about or barely use anymore. Now you might be thinking, that's not really a bank habit, but here's where it connects directly. Most people have their subscription set to auto-renew on a credit card or pulling directly from their checking account. The bank is processing every single one of those transactions. And more importantly, this habit keeps money flowing out of your account on autopilot without you ever making a conscious decision, month after month. The fix is spending 15 minutes once a month going through every single transaction in your checking account and credit card statement and asking yourself one question about each charge. Did I actively choose to spend this money this month, or did it just happen automatically? You will find money leaking out that you completely forgot about. Cancel what you don't need. Negotiate what you do need. Most people find between $50 and $200 a month in subscriptions and forgotten charges the first time they do this exercise. That is $600 to $2,400 a year that could be going toward building your actual wealth instead of silently disappearing every month. This one is one of the most expensive habits on this entire list, and it is so normalized that most people never even question it. Financing a car. Now, I'm not saying don't buy a car. Most people need one. What I'm saying is the way most people buy a car is one of the most effective wealth destruction tools the financial system has ever created. Here is what actually happens when you finance a vehicle. You borrow money at anywhere from 5 to 10% interest to buy something that loses 10 to 20% of its value the moment you drive it off the lot. You are paying a premium to own something that is actively losing value every single day. And then on top of the interest, you have insurance costs that go up with a newer vehicle, registration fees, and maintenance. By the time you add it all up, a monthly car payment of $500 is actually costing you closer to $700 or $800 a month when you factor in everything attached to it. The alternative that financially free people quietly use is buying a reliable used car in cash. Not the newest, not the flashiest. A car that gets you from point A to point B without a monthly payment following you around. Then taking the money you would have spent on that payment every month and putting it somewhere that grows instead of shrinks. The difference over 5 years between a $500 monthly car payment and a paid-off used car is $30,000. That is not a small number. That is a life-changing number for most families. The bank wants you in that dealership every 4 to 5 years, trading up, rolling negative equity into a new loan, and starting the cycle completely over again. That cycle makes them a fortune. Breaking it makes you one. Here is something most people never stop to think about. Every single day, your money sits in a checking account. Doing nothing is a day the bank is using it to make money for themselves. That is how banking works at its core. They pool deposits together and lend them out at higher interest rates. Your idle money is their working capital. Now, you can't stop that completely. But what you can control is how long your money sits, doing nothing before it goes to work for you. The habit that financially free people build looks like this. Money arrives on payday, and it moves within 24 hours. A specific amount goes to a high-yield savings account. A specific amount goes to investments. A specific amount goes to bills. And only what is needed for the week stays in checking. Money never just sits. It always has a job. The reason most people don't do this isn't because they don't want to. It's because they haven't built the system yet. Setting up automatic transfers takes about 20 minutes. You log into your bank. You create a recurring transfer on payday to your high-yield savings. You set up your investment contributions to pull automatically. And then it happens whether you think about it or not. Whether you're having a good month or a bad week, whether you feel like it or not, the money moves. The biggest enemy of building wealth is not income. It is inertia. The bank profits from your inertia every single month. Automation removes the decision entirely and makes saving the default instead of the afterthought. This one is going to surprise a lot of people because it sounds like a smart move on the surface. Refinancing your mortgage to get a lower rate or a lower monthly payment. Now, sometimes refinancing genuinely makes sense. If rates have dropped significantly and you plan to stay in your home long enough to recoup the closing costs, it can absolutely save you real money. But the trap that banks quietly love is when homeowners refinance and reset their loan back to 30 years every few years. Here is what that actually looks like in practice. You buy a home on a 30-year mortgage. 5 years in, you refinance to get a slightly lower payment. Your loan resets to 30 years again. Another 4 years pass, and you do it again. Now you have been in your home for 9 years, and you have a brand new 30-year mortgage. You will be paying for that house for 39 years total, and every time you reset the loan, the bank collects a fresh round of interest starting from the very beginning of the amortization schedule, where almost all of your payment is interest and almost none of it is reducing what you actually owe. The smarter move that most people never hear about is making extra payments directly toward principal whenever possible. Even one extra payment per year on a 30-year mortgage cuts the loan down to around 24 years and saves tens of thousands of dollars in interest over the life of the loan. You don't need to refinance. You don't need to do anything complex. You just need to understand that every extra dollar you pay toward principal is a dollar the bank can no longer charge you interest on. That is money moving from their pocket directly into yours. Banks collected over $10 billion in overdraft fees alone in a single recent year in the United States. $10 billion. Not because people were forced to pay those fees, but because most people never questioned them, never called to dispute them, and never knew they had options. Here is something most people genuinely do not realize. Almost every fee a bank charges you is negotiable or avoidable. Overdraft fees, monthly maintenance fees, wire transfer fees, late fees on credit cards, every single one. If you have been a customer in good standing for any length of time and you call and politely ask to have a fee reversed, the majority of the time they will do it. Banks would rather waive a $35 fee than lose a customer relationship worth hundreds of dollars a year. But they count on the fact that most people will not call. Most people will see the charge, feel a flash of annoyance, and move on. That inertia is worth billions to the banking industry every single year. Beyond disputing fees, the other piece of this is shopping your financial products the same way you would shop anything else. Your car insurance rate, your home insurance, your credit card interest rate, your bank savings rate. These are not fixed numbers handed down from above. They are starting points for negotiation. Most people accepted the first rate they were given years ago and never revisited it since. Call and ask for a better rate. Tell them a competitor is offering you something better. You will be surprised how often that simple conversation results in an immediate improvement. The financial system is entirely built on the assumption that you won't ask. Ask. The last habit is the quiet one that underlies every other habit on this list. Having no structural barrier between the money that comes in and the money you spend. When your paycheck lands in the same account you use for daily spending, the psychological pull to spend it is almost impossible to resist consistently. You see a big number and your brain registers safety and abundance. You loosen up a little. You treat yourself because you feel like you can afford to. And by the end of the month, you're genuinely not sure where the money went. This is not a willpower problem. It is a systems problem. Willpower is limited and it runs out. Structure does not run out. The solution is physical separation. Your income lands in one account. Your spending money for the week gets transferred to a completely separate account. When that spending account hits zero, the week is done. You don't move money over. You don't dip into the main account. The week is simply done. This one structural change eliminates the end-of-month mystery of, where did all my money go? Because you already decided at the beginning of the month exactly how much could be spent. And when it's gone, you know exactly why. Banks make money when your financial life is disorganized. Every overdraft, every late fee, every minimum payment on an impulsive purchase, it all traces back to having no structure around how money flows through your life. Build the structure once, and it protects you automatically every single month after that. Banks are not your enemy, but they are absolutely not your friend either. They are a business. And every single habit we talked about today is a habit their entire business model is quietly built on you, keeping forever. The moment you move your savings to a high-yield account, you stop giving them free money. The moment you pay more than the minimum on your credit card, you start escaping the interest trap. The moment your paycheck moves automatically on payday, you stop living paycheck to paycheck. The moment you start questioning every fee, you stop being the easiest customer they have. None of this requires a high income. None of this requires a financial advisor or an expensive course. It requires understanding the system you are already living inside and making small, deliberate changes to stop letting it work against you. Start with one habit this week, just one, because one change becomes two. Two becomes a system, and the system becomes the financial life you actually want. Which of these 7 habits were you guilty of? Drop it in the comments. I read every single one. And if this opened your eyes even a little, subscribe. Next video, I am going to show you exactly where to move your money instead of letting it sit and die in a regular bank account.